Well, I think it's a double-edged sword. What was interesting yesterday with that aggressive rate cut was the near 4% decline in bank stocks. So, the temptation is to say, well, this is going to help, risk appetite. This will help the home builders. And you saw the great numbers on mortgage applications. But it's definitely not good news for the banks any more than these ultra-low rates have been good news for the banks in Europe. And I refuse to believe that you can have a healthy economy if you don't have a healthy banking system. So the lower rates will help out some parts of the economy. But my big concern at these low levels is that it's going to hurt other parts of the economy, and it comes out as a wash.
What do you guys think of Prudential's QMA?
So, I think the rate cuts are necessary but insufficient. They're not going to fix global supply chains. They're not going to get scared consumers to venture out into sporting events. But I do think they're likely to help market sentiment on the margin and keep credit flowing. To the degree that we have broader fallout from the virus and it causes demand destruction, I think it will help support the recovery once we kind of get past the worst in terms of net new cases. So I think it's something that has to be done, but it's not going to fix our problems.
As for the rally today, up 400 points on the Dow, clearly the talk is Biden and the boost of the moderate candidate into front-runner status. Do you see this as any sort of lasting help to a bruised equity market?
So I think we've got a lot of cross currents here, right? So we've got the push and pull of the negative impact of the virus and the positive impact of the policy response that we're seeing, not just in the U.S., but around the world. And then, as you mentioned, Biden had a Lazarus-like reemergence on Super Tuesday, and this decreases the probability that the Democratic nominee is going to be a socialist and all of the negative policies associated with that. So I think that is definitely helping today.
But would you buy on that?
I wouldn't buy solely on that, no. And I do think that this whole situation is generating a buying opportunity, but I don't think we've seen the maximum drawdowns as of yet. I think we still could see another 5 to 7% downturn just associated with the rising.
From here?
Yeah, just associated with the rising probability of a global pandemic pushing the global economy into recession. I think we can't discount that. So I think there is some more downside here.
Where are you, David, on the equity market?
Well, I think that you want to focus on the best leading indicator that there is, which is the long bond yield. And the Treasury market is telling you that if we're not going into an outright recession, we're certainly going into a significant growth turn down. And we're in a period, of course, alongside that where the uncertainty around the earnings outlook is as wide as it's been at any time during the 11-year recovery period. And when you're buying equities, you're buying the earnings outlook. And so I think we're in a bog right now. I think recession risks are on the rise. That's negative for the E. I think the heightened period of uncertainty is not going to go away anytime soon, and that's a negative for the PE multiple. So I think that, we're going to be stuck with a lot of volatility. I think the overall market is still going to be vulnerable more to the downside. And your best bets are going to be in areas of the market where the dividend is safe and you're in areas of the market that are non-cyclical.
Hey, David, how far away is recession from your base case right now?
I think it could start as early as next quarter. I know that there's a lot of excitement over ADP and over today's ISM, but I don't know why you'd be focused on those. We got the University of Michigan Consumer Sentiment Index on Friday, and it was just fine. But February numbers, especially when you consider the stock market didn't peak till the third week of the month, these are all yesterday's numbers. I think going forward, we're going to be seeing significant weakness in the economy starting, I think, next month. And until we get some semblance of stability on the coronavirus situation, I think that the risk is that you're going to have the consumer sector follow last year's manufacturing recession and hunkering down, savings rates go up, and I think the general outlook for the next few quarters is going to be very weak.
So you guys are both kind of a gloomy pair here. Ed, so what is an investor to do if you do expect another, 5 to 7%, you said, down on the market? Where do you hide out? Where do you allocate?
Well, so, bonds and gold have been a very effective crisis hedge here. I mean, I do think you want to be nibbling in stocks. You know, you're not going to call the bottom exactly. So, you know, putting money to work on weakness does make sense. I think if we do experience a recession, it's more likely to be a technical recession than a true recession. So the economy could come roaring back here when the threat of the virus passes and given all the stimulus that we've put in place.
Where are you nibbling? Certain sectors?
Really broad market exposure. I would say S&P 500.